friends lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. The numbers make sense. Jeb shows a vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome to another week of the Educated Homebuyer Live. My trusty counterpart here, Mr. Josh Lewis, will be coming in here in just a moment. I see him popping in right now. There he is. We'll add him in, regardless of whether he's ready or not. Josh, welcome. Can't hear you. That's fantastic. You can't hear you, so you need to fix that, and then you can come in. But while Josh is trying to fix that, let us know where you're watching from. We're going to get into some charts as we always do. We're going to dive into your questions afterwards. So if you have questions about housing, about real estate, start putting them in. Some of the good news that we're going to touch on this evening is that we've seen a pretty noticeable drop in mortgage rates since our last conversation last Wednesday. So the big news last week was that non-farm payrolls came in way better than expected, lower than expected, I guess, if you will. Josh, are you here? Is that better?
Of course, we are here.
There we go. And then we got some revisions down. And because of that, we actually saw interest rates move to the point now where we're sitting at a 2025 low with mortgage rates and 9-ish or maybe even close to 10 months low. So, Josh, what do you want to start with?
No, that was good. I'm sad that I had to run across the hall and I missed the intro because I actually was able somehow. One of our friends, Gabe, had never heard it. I'm like, this is an international hit. I don't know how you have not heard this. So I played it for him this week and he was highly amused. Highly amused.
Amused. Amused isn't what I want to hear.
Impressed.
Impressed is better. For anybody that wants to use that, download the MP3, whatever, let us know. We'll send it to you. You can, well, actually, maybe we could put it on the podcast and you could just play it. Like you could just hit that track on the podcast and play it.
Sam's here for the sick music and you got it. You got it to lead the show off. We hit hard right from the very beginning.
Yeah, we don't want to delay that. I mean, you guys are here for this good stuff. We're giving it to you. All right. So what we're going to do is we're going to look at some charts. We're going to start there. And Mr. Lewis, I don't even have my notes up. But you know what? We don't need them. We don't need them this week. We saw inventory increase minuscule this past week, 860,000 to 865,000 homes. I think it's like 26.7% or something over last year, rounded up to 27%. This time last year, we were sitting at 683,000 homes. So again, inventory has not peaked for the year at the moment. And depending on what happens with rates, it might be a couple of weeks, a couple of months before we actually see that peak. But with that, as I mentioned last week, we're not going to dive into a lot of the charts, but we are going to talk about what's happening here in Orange County and what's happening in Huntington Beach. So Orange County still seeing an increase, 5,009 homes. I think our peak this year is 5,022. So we're just below that at the moment. So 0.2% up week over week. And then Huntington Beach sitting at 305 listings on the market. I think our peak here is right at that number, 305, 309, somewhere in that ballpark. So pretty much where we have been, or the peak of where we've been. And that was a 3.61% increase week over week. And then we normally talk about new listings. Actually, I added some charts in here this week. This is another look at inventory. The reason I like this chart is it goes back a little bit further, shows you what the market looked like 2017, 2018, 2019. And just to give you some context there with regard to inventory. So yes, we're increasing over last year, still below those numbers from prior to the pandemic. Just to provide a little context, active inventory here, going back from 2019 to 2025. How do we compare from July of this year to July of 2019? So a lot of the states out there still showing negative with regard to where we are inventory wise, but at the same time, we've got states that are showing noticeable increases. Texas up 32%, Florida 29%, Tennessee 31%. Washington State up 31%. In fact, if you want the full list, I believe I put it right here. A little difficult to read on this chart, but I think you have 12 states at the moment that are back to pre-pandemic levels, but 2 of them are sitting at 0%. So 2 of them are even from where they were back then. So you actually have 10 that are above 2019 levels, but either way, that
Jeb,
number is increasing.
I have two anomalies here to 13% less inventory. But if you saw the Zillow forecast last week, almost all of the markets that they expect to have the biggest drop in prices over the next 12 months. Not that Zillow is God, but their forecast, their data is saying that's going to be the biggest decrease. And yet they're still below pre-pandemic levels.
So I missed the state that you said because you froze. I mean,
Louisiana.
Typical of Louisiana. Okay, so Louisiana.
typical frontier FIOS.
Yeah, if you haven't been here in a couple of weeks or months, we still freeze every week. It's fantastic.
With ultra fast internet.
Yeah,
when it works.
2
60%
gigs,
of the time, it
2
works
gig
all
speed
the time.
of internet an hour without freezing up. So
Jeb, there's one other anomaly in this data that I'm going to like to point out. Oregon is 0%. Nevada is negative 0%. It's confusing me.
That is very confusing. In fact, we should reach out to
Lance
and figure out what a negative 0% is. So again, there's that chart, and then new listings. I'm not going to bore you with this stuff every week. We've talked about it. It looks very similar to where it has over the last couple of weeks. We're still above 24 levels, but not in any noticeable way. Pretty much trending like we always have. Price reductions kind of flat week over week, but still up noticeably from last year, sitting at 41.7%. So I talked about it earlier, Josh. We started the show talking about non-farm payrolls. Came in noticeably less, I think 77,000 or so from what was expected over 100,000. So what do we got?
And that wasn't the big issue. If you'll look, the previous 2 months, I should have shown what they were before revisions. The previous 2 months looked like they were nicely solid numbers. Last month before the jobs report, Jeb, we were talking about, hey, partially why we're not seeing the unemployment rate go up is at the replacement level. The number of jobs required for the economy to create each month to not create increasing unemployment is smaller. So when we have smaller required, smaller jobs created, we're still kind of sitting here at this level. So saw some huge revisions to the data. And the important part for those of you who were here last week and take notes and remember, we had talked about the ADP data had shown a 12-month average of like 125,000 jobs created. The 6-month average was 67,000 jobs and the 3-month average is 32. And we talk about how over the long term, the BLS data that gets revised, the long-term revisions are highly correlated to ADP, but we need need to see those revisions. Well, we got some heavy revisions last Friday. They're dead on 32,000 jobs on average over the last 3 months with where ADP is at. That's below replacement level. That will lead to unemployment increasing, and that has got the Fed's attention. So we're going to go through some data here. This is a different chart than the way we normally look at bonds. This is I think it's the hourly. No, it's less common, less often than hourly, but this is going back to last week. So when you see that big green candle of the 10-year yields dropping, that was the reaction to the Fed data. And you can see we moved a little lower, moved back up a little, but have held most of those gains this week. Sort of a counterpoint to this, Jeb, tomorrow, Thursday, every week we get initial claims for unemployment. That number has been low and steady and stable for the better part of 2 years. So we're seeing employers are creating less jobs. They're doing less hiring. JOLTS data shows every month less job openings. They're posting less jobs, but we're also not letting people go. So when you normally see an economy turning, unemployment going up is when employers start going, hey, we got to let people go. Right now, they're still holding on to the good employees they have. So we have that tension there. And it's partially why we're not seeing a monster drop in interest rates. Last week, we showed that for Q2, we ended up at 3% GDP. It was distorted data, and we really need to average that because of the front loading of imports in the first quarter due to tariffs and less imports in the second quarter. If we average those out, we're at about 1.25% growth for the first half of the year. The blue chip consensus is that we're going to be at 0.75%. Of the Atlanta Fed, this is not them prognosticating or throwing out data. What they do, it's a nowcast. They're pulling in all of the data. We're very early in the quarter. That will swing pretty wildly over the next few weeks. But that blue chip consensus usually ends up pretty darn close to where GDP now ends at the end of the quarter. So it's not a recession. It's positive growth. We're just not growing anywhere near as much as we need to have a robust economy. The other thing the Fed looks at, Jeb, is inflation. We don't really have any inflation reads this week, but trueflation is down to 1.74. I think it was 1.65 last week, but it had been up over 2%. So if we look at that trend, we're still in a downtrend here. And that is also, again, more of an instant nowcast than something like CPI or PCE that is looking at more dated data. So it's telling us that we are on track to meet the Fed's objectives as that data gets absorbed in here. So where are we at now with this? We a week ago on Wednesday, I think we were projecting one cut for the rest of the year, Jeb. They were down to, and now we're sitting here. We got a 94% chance. That was over 95 just this morning, but a 94% chance of a cut at the next meeting, 60% chance of a cut at the next meeting. If we didn't get it there, 56% chance at the meeting following that. So we're down to only 2 cuts priced in, whereas last Friday it was like 60% chance of 3. So keep that in mind. We have some other charts in here that we want to look at and show you guys. And this is probably the important part. If you are looking at this going, rates have finally broken lower. They're going to go lower. This is it. This is my run down to 6%, and I'm going to get in, or I'm going to wait and I'm going to refinance. This is what happened last fall. So those 30-year fixed mortgage rates, those 3 yellow arrows are the September, November, and December rate cuts. The Fed cut 50 bips, 25 bips, 25 bips, so a total of 100 basis points. The market had already taken rates down to 6.25 roughly there before the first Fed cut. They did continue to go a little bit lower down to about 6.1 before starting to run all the way back up over 7%. So I had a conversation, Jeb, earlier with a listener that we did their purchase loan last year that we absolutely should be doing the refinance right now. We are going to talk tomorrow, but his reply was, can you just put a call on the calendar for September 17th? I think the Fed's going to cut, so we should talk then. And I showed him this exact data. You can't wait for the Fed to cut. So the Fed funds futures market is pricing in a 95% chance, 94% chance of a cut on September 17th. The bond market doesn't sit around here and wait. Mortgage bonds, treasuries don't sit around and wait and go, hey, let's see what the Fed's going to do. We've talked about this a million times. We did an episode about a month ago on the podcast of what the Fed controls and what they don't control. They control the very short end of the yield curve, directly federal funds rate, the prime rate, which is credit cards, home equity, lines of credit, and then ultra short-term stuff, bills and notes that are like 2 years or less. This is really market expectations of inflation and economic strength going forward. So if you are in the money right now, and it makes sense, you can save $200, $300, $400 take a look at it, consider it seriously if you can do that with no cost. And then you would be able to take advantage if at some point in the future we get that roll down later in interest rates. The rest of this stuff I have in here, Jeb, we get stuff, lovely comments from armchair economists telling us we don't know what we're talking about. The economy's terrible. Everything's falling off a cliff and it's going to implode here shortly. So Lance threw some really good data here. This shows you percentage of loan balances that are 90 days delinquent. So you look at HELOCs and mortgages, they both are very low, under 1%, and have trended down recently. Autos trending down, credit cards trending down, student loans massively up because they had nowhere to go but up. There were no payments, so you can't be late on a payment that you don't have. And now you have that ability, and many people have gone late on that. So transition from 30 days delinquent to further, this is 90 days delinquent. So 90 days is seriously delinquent. On a mortgage, you are about ready to get foreclosed on. So 30 days delinquent, how many of them are transitioning into seriously delinquent to that 90 days? So HELOCs and mortgages either flat or slightly trending up, autos down, credit cards down. This has been pretty flat, and mortgages have slightly improved from a slightly elevated level. Transition in 30 days delinquent by mortgage type. So this is really important depending on where you are in the country and the predominant mix. In most parts of the country, FHA loans are less than 10% of the market. They have very little impact to move the market, but you can see from the first quarter of 2021, when the forbearance stuff started ending, to now, we've gone from just over 1% of those loans up to about 4%. But at the peak in 2009, 6% of those loans were 30 plus days delinquent. VA has had a little bit of an uptrend. GSE loans, so meaning Fannie, Freddie, trended down here recently. Other loans, jumbo loans, non-QM, trending down. So no signs really here of stress or weakness in the market other than FHA loans. So again, where are you at? We talked about Louisiana. That's where Zillow predicts a lot of weakness. 18% of that market is FHA. We got Mississippi and Alabama, 22 and 17, Georgia, 17, Texas, 17. So if you're in a market where there's a lot of FHA loans, and especially if you're in an entry-level market where there's more FHA loans, those aren't evenly distributed throughout those states. For us here in Southern California, like the Inland Empire, Riverside, San Bernardino, more FHA loans, more entry-level buyers. There is greater risk, even though we just went through and said there's very little risk, systemic risk in the mortgage market right now. I thought this one was interesting, Jeb. John Burns Consulting, mainly a real estate consultant, but threw this in as a comment on immigration policy. So we have a 2.1 million decline in remittances to Mexico. So a lot of that is people here legally or illegally with family in Mexico and sending money back home to Mexico. So this has dropped a lot. I had two thoughts. Clearly, the timing of it coincides with the immigration issues. So either the people aren't here, or they're not working and making money, or they're being very, very careful about sending money home. And then, Jeb, my last thought here is we've seen a big uptick in stable coins here recently. This is through Banco de Mexico. So when we look at that, did you see my perfect?
I heard it.
I wanted to pat myself on the back. I was proud of myself. But anyways, that is through the banking system. Stable coins are a big way of money going around the world, but especially to countries with less stable banking systems. Not that Mexico doesn't have a solid banking system, but could be a rise of all those things. It's something to watch. So Jeb, here, when we look at this, we're in a pretty wide range, but definitely a downtrend here going back to, say, the middle of June. The last couple days here trending up. We had a big uptick midday that was almost unexplainable. No data came, but we saw treasuries pop up like 5 basis points and then correct within about 15, 20 minutes and on large volume. It wasn't an anomaly of just like one big trade going through. But as long as we stay here, it would have been nice. Like the two levels, the yellow line and the green line there at the bottom is basically 420 and 413 on the 10-year are the next levels of resistance that we really need to break through to see more improvement. You've seen we've had 3 days here kind of approaching that 420 and it give way. So it wouldn't be surprising to see rates get worse in the near term before hopefully resuming this downtrend. What does that mean for interest rates? 6.57 per Mortgage News Daily, down 0.18% over week. I would say most of our lenders are closer to 0.25% down over the week. FHA and VA, 6.17, 6.18. Most of the VA and FHA quotes we have right now are under that level, depending on loan size, location, credit score, all of that fun stuff. So last thing I wanted to leave us with here, Jeb, we've looked at this chart before, but Lance keeps this updated. So in Q1, only 41% of people said they would be in the market or be willing to accept the 6% rate on their next loan. It's up to 52%, down to 5.5%. It goes up to 66%. And if rates got to 5%, 86% of homeowners would accept that on their new home purchase. So I'm not saying we're getting close to 5%, but you're seeing the people are getting more comfortable with higher interest rates as rates stay higher for longer. And we are seeing some moderation back in our direction. Logan wrote this article today, why 6% mortgage rates will reignite the housing market. And if you look at that, 6% gets you where at least half of the market is willing or interested in buying there.
Good stuff. And this QR code or the website, jebsmith.net/RateWatch is our system to kind of keep you updated on interest rates if you're looking to refinance. So if you're somebody out there that maybe has a 7% or a 6.5%, and you're saying, hey, when it gets down to 6 or 6.25, when it makes sense, I'll refinance. We did this to kind of keep track so that you guys don't have to. It's an easy way. I know we have a couple hundred people on it right now that have done it before. We haven't really mentioned it because rates have been higher, but now because rates are trending a little bit lower, want to throw it out there. So jebsmith.net/RateWatch will get you on that list and having that conversation with Mr. Josh. So Josh, do we have, we got Drew let us know he's watching from the North Georgia mountains. Sounds beautiful. Is that, are you like Appalachian, like on the trail there? Like you can just, hike, just jump on there and hike all the way to Maine, or what are we doing? You can actually. I had a buddy that did that, but
I thought you were saying you and Justin were going to do it.
No, it took him 6 months, to do it. He did it straight. It's crazy. Some people do portions of it over time and eventually finish it. And then some people just say, you know what, I'm doing the whole thing. So 6 months later, he finished. Crazy beard, big calves, lost probably 40 pounds in the process. Anyway, Quan has a question. I'm assuming Quan says, can we do a call-in? We have explored the idea of some sort of call-in previously. The problem with putting any sort of live call on the air is it's a live call on the air, and it could go a lot of different directions.
You could say something crazy, and we
could get in trouble for that. So we've considered maybe creating a number where people can call and leave a voicemail that we can play and answer the question there. So how about next week we'll readdress this question. We'll have an answer for you and potentially a phone number that you can call to do that. How's that?
Jeb, I got a better idea. How about Quan volunteers to be the first guest on the podcast where we break down and talk about their situation and kind of give a look or a view into
what Quan a past client?
Quan is not. Quan is a prospective client. We bring him in and we do a strategy session.
Got it.
He's got a Baltimore Ravens sign there, so he's probably not buying in your market, but you can give the real estate view of it. We can kind of give the mortgage view of it and give people kind of a behind the scenes look at what we're talking about. So Quan, you would have to open the kimono. I don't know if you're open to that, but let us know.
Yeah. So for those of you who don't know, we actually have a podcast called the Educated HomeBuyer Podcast here on YouTube. It's also on Spotify and Apple and all those places that you get podcasts. But, it's a deep dive into different content on the mortgage process, 30 minutes or so. Josh and I is kind of going back and forth on a lot of stuff just to help you understand the process. One thing that we've recently considered doing is calls with clients that have actually purchased homes. Because one of the questions that we get all the time is who's actually buying in this market? Like, who are these people? How much money did they have? Like, how could they afford it? And we've thought about doing a little story session where we actually bring these people on and we talk about it. Hey, what was your income? How much down did you have? How long did it take you to save it? Was it a gift? Was it parents? Why were you comfortable with this amount? So on and so forth, and just take you through it. So if you think that's a good idea, just type a 1 in the chat. Let us know. And if you don't like it, you think it's an awful idea, and Josh and I should just quit everything we're doing, put a 2 in there.
And hike the Appalachian Trail. Maybe we'll make a YouTube channel about that.
Yeah, we could do that. Let's see. Quan does have a question, though. Says he's 28, finally out of debt after 7 months. Asking if it's possible to, there's no.
Paid off $7,000 last month and he's debt free now. With me not having any bills, is it possible to save for my down payment while in the pre-approval period. So here's how I always like to tell people. I am most focused on the income and the credit because those are fixed issues. Like for the most part, you can't make a change in the near term. You're not going to get a monster raise. We need to calculate the qualifying income, not what you think you make every month, but what your qualifying income is per the underwriting guidelines. So from that perspective, if you tell me, come hell or high water, by closing 60 days from now, I will come up with the money. I can tell you this is how much you need. You're going to need $24,000. And you say, either my grandma's going to give me the money or, hey, here's my budget and I'm going to save $4,000 a week for the next 6 weeks and I get to it. I'm okay with that. So from the guideline perspective, what does that tell us? If you're saving the money as you go, it's fine, but we just have to show where it comes from. If you make net $1,200 a week and there's $4,000 a week going into your account, underwriter is going to rightfully ask, where in the hell did this money come from? It could be a gift. You could have sold stuff. You're going to have to be able to document that you own something, preferably something registered with the government with a bill of sale that was very expensive. I have had situations where someone had a very valuable trading card, a comic book, weird sorts of collectibles that are very valuable. We're just going to have to be able to document from a real source. So hopefully it's just coming from paychecks and your normal income, but there are definitely ways of documenting that money.
All right. Orange Pulp says, question for a friend. He accepted an offer from a buyer that agreed to waive inspection, but his realtor is saying he needs one anyway to move the process along. Does this sound right? Yes. I would, even if I waived any sort of inspection period or, on the offer, just saying, hey, listen, I'm willing to buy this house regardless of the condition, I would still recommend getting an inspection just so you know what you're getting into. Now, in the case that you're buying it to flip or, you're going to tear it down or do major construction in it, may not be necessary. But yes, in situations where inspections are waived, I see them done all the time, just from a knowledge perspective, knowing exactly what's going on in the home.
Let me ask the question this way, Jeb, because this is the way it always comes across.
Mm-hmm.
The buyer agreed to waive the inspection. I don't know that I've ever seen a contract written saying, I will not do inspections. It's waiving my inspection contingency,
Sure,
where I cannot use that as a reason to back out of the transaction. Do you ever see a contract that says I will not do inspections, or is it really just a verbiage issue where the people don't realize you're not waiving your inspection, you're waiving your inspection contingency and ability to use that as a reason to back out?
correct. Yeah, exactly like you said. Yeah. Instead of just dragging it on, that's accurate. We have a question here from Steve, who is an accidental landlord, and just saying, can you lend conventional in Florida? The easy answer for that in Josh is yes. But I'm going to go on a step further here and address the bigger question I think the bigger thing that should be addressed here is, you're saying that you're getting an APR quote around 7.01 for an investment property. Josh, let's talk about why APR is not the right thing to be looking at.
APR is worthless. It's a government like synthetic number that they came up with. And what it is, I won't even bore you guys with the details because you wouldn't be able to follow along, but certain closing costs are considered prepaid finance charges. So they use this number, they take your loan amount, reduce it by the prepaid finance charges, and then calculate the APR. In simplest terms, if it's a refinance, you want to look at sort of all of the fees, because we are able to negotiate everything on the left side of the loan estimate: box A, box B, box C. The lender is responsible for box A and indirectly box B. And then they're also, on a refinance, I generally get to pick the escrow and title company, so I'm responsible for box C fees. Any mortgage taxes, transfer taxes, recording fees, that type of stuff is never going to change from one lender to the next. So really what you want to look at is, what is box D, which is the total of A, B, and C on a refinance? What is my box D charges for this interest rate? Because I can almost bet at a 7.01 ARM, this is our typical thing. Refinance lenders love to quote a really, really good rate. And oops, there was 2 points in there. So it's less likely to be 6.875 with 0 points leading to a 7.01, and much more likely to be a 6.5 with a couple of points in there. So absolutely use the link in the scroll there, and we can go through it and we can kind of show you the numbers and show you what you really should be looking at to compare quotes.
All right, here's a question from one of our regular viewers, Willing, says, have you ever had a deal slip because the appraised value came in way higher than originally thought, and then the property taxes and the homeowner's insurance go up as a result of that higher price? And so I think there's a misunderstanding here, Josh, of how that appraised value actually impacts things like taxes and insurance. So you want to explain that real quick?
So the property taxes are determined by the assessor's office. You could have 5,000 appraisals. Someone could do an appraisal and come in and say, your house is worth $1 billion. The assessor's office doesn't agree. You could have someone come in and say your house is worth $300,000, and the assessor's office come out and tell you, nope, we ran the numbers, it's $405,000. So the appraisal really has no bearing on what the property taxes are going to be. It doesn't get reported to the government, doesn't get handed to the government. So it would not impact your actual taxes. The HOI, also the homeowner's insurance, what is that based off of? It's based off the replacement cost of the home. In general, whether it appraises for $300,000 or $600,000, the insurance company is going to run their own number and come up with a replacement cost estimate. So now they know, what does it take for us to rebuild this if something were to happen, if there were a loss, and then calculate the premium accordingly. So neither one of those should be impacted by the appraised value.
There you go. Julio says, how can a tipped employee go about buying a house? So Josh, we actually have an episode dropping on Monday where we talk about the big, beautiful bill and its impact on affordability and the housing market, and how all of these little changes that are that passed in there, tipped employees, that sort of thing, could actually benefit some of those sitting on the sidelines. But in layman's terms, so that'll be actually on Monday. But if we just answer that question, Josh, tipped employee, how do they go about buying a house? What do they have to do?
So prior to the one big, beautiful bill, the answer was, if it doesn't get reported to the IRS, then it doesn't count. And historically, until, I don't know, about 10 years ago, the payroll systems didn't account for it. Now, when you cash out at night, most restaurants, bars, things of that sort are making you say, hey, here's my tips also. And it shows up. Even though you walk out with them in cash at night, it gets reported to the government. So the interesting part, what we haven't quite seen yet, is how ADP and Paychex and all these companies are going to account for this, because now you can report it if you make, what is it, 100,000, 115,000 or less, Jeb. If you make less than that, your tips are not taxable. So you would be happy to work for as low a wage as possible and as high of tips as possible, as long as you stay under that threshold. But again, it should still be reported. The government wants to know what's out there and what they're foregoing. So it might make it where you have more honesty in reporting with this, at least for people below those thresholds. So as long as it's reported and we can see it documented, you can use it. If you put tips in your pocket, they don't get reported to the government anywhere, then you're looking at a situation where you're going to be having to do it like a self-employed person that has a very low tax return net income, where you have to do a bank statement loan or something along those lines.
All right. We had a question here, Josh, that I wanted to throw in there. Where is it? The one we addressed earlier. Drew is asking, should I wait until September to reapply for a mortgage? So with the expectation that something's going to happen in September to make it less expensive to apply. Here's the thing. If you apply today, if you applied 8 months ago, if you applied whatever, and your credit's still the same, your income's still the same, all of that's the same. There's no need to reapply just because interest rates go down, right? It's only going to benefit you. All it is a call to that person who pre-qualified you and ask them, hey, where are rates today based on my scenario? And they can just update those rates. So it doesn't matter when you apply. It's what happens with mortgage rates during that period of time from when you applied. But the idea that waiting until September is going to be this magical formula, understand that the bond market has already priced in what's likely to happen in September. The fact that we saw interest rates drop considerably on Friday, followed by, pretty much solid sideways movement since then, Monday, Tuesday, Wednesday of this week, and the Fed funds futures going from 1 cut to 3 cuts, tells you that the market's expecting this to happen, and that's already built into mortgage rates. So waiting likely means higher rates than taking advantage of something that is a moonshot in waiting, that the Fed's, what they do is going to actually have a huge impact on lower rates.
Well, I wanted to say, I get tired of saying this, but I can't get tired of it, because I'm going to say it until I stop doing loans. The Fed does not dictate mortgage rates. The market is looking at the same things you are. Let's imagine buyers and sellers in the treasury market and mortgage-backed securities probably know even more about you than you do about the future Fed likelihood of changes, cuts, hikes, whatever. and it's priced in every day. Efficient market theory says markets know at all times all the data, and it's all absorbed and assimilated in the prices. Efficient market theory may not be 100% accurate, but in this sense, the markets are 100% efficient. What we know about future likely Fed moves is 100% priced into the market today. So unless you have some special knowledge that says what's going to happen in the October meeting or the December meeting, I would probably not be waiting for something to be materially different than it is today.
There you go. We got a couple different questions here. This one pops up. It's a little bit different, so I'm just going to click on it. G Money's in San Diego, I believe. He updated it a moment ago. Says, I always enjoy your show. Beginner landlord, how would you go about splitting utilities in multiple units on the same property? So I actually have one that I manage for a client in Santa Ana, and what she does is she divides it by the number of people occupying the unit. Like, so for example, utilities, water, sewer, trash, that sort of thing. She has the set bill and she divides it by not only by the unit, but by the number of people in that unit. So if you're 2 people in that unit, you're going to pay more than 1 person occupying the unit. Same with water, sewer, trash. So that's the easiest way to do it. And it's all preset up front. So it's, at this point, she has an average over a period of time of what that cost is going to be. And so she might be up a little bit, down a little bit on any given month, just depending on what that is, but it's preset into the lease what that amount's going to be. And then every year it's updated based on what that average is. Now, if you're going into it and don't have that information, you might have, if you have any sort of past client information that has utility bills or that sort of thing, could give you some sort of baseline, or you could do some sort of estimate. And as long as all the tenants are in agreement on it, you should be good to go. But Josh, your units, Long Beach, they all have separate meters, or they
separately metered. So I was going to say, when you buy the property, make sure you buy one that's separately metered.
Yeah. So, I mean, there are definitely ways to do it. I've seen it done both ways, but it's, I think the easiest way is just to, get an average and divide it and say, this is what it is. And, as long as it's negotiated up front, there should be no issue. Let's see, Josh. Eat and travel with Q. We're first-time home buyers in escrow on a place in Simi Valley. Just wanted to give you guys I'll give you thanks for the great content. Been watching throughout the process and have gained a lot from you too. So appreciate you guys. Yeah, thanks for dropping the comment in here. It's funny. Like, people say, you think, hey, you're probably just reading that because it's like a pat on your back. No, like, the problem with some of these comments is they're long and they're hard to decipher exactly what they're getting into before you read them online. But we appreciate that. Josh, did you help him with his mortgage?
We did not. Q did not reach out and give us an opportunity to help him with his mortgage. That's the best way to show your gratitude for the educated home buyering.
There you go. Slow motion for me says, what's your opinion on Toll Brothers, and do you have any builders to avoid? I do not. Where I am here locally in Huntington Beach, we only have a couple, mostly infill developments. They all are pretty much doing the same sort of thing. When you get out into areas of Texas and, where these builders doing mass tracts of homes and that sort of thing, and they're, slapping them up in weeks and months, and then the wind blows and you see videos on like Instagram of the house just
blows away
and just snap. Don't buy from those. Find those builders and don't buy from them. Other than that, I don't have any recommendations, unfortunately, or ones to avoid, rather.
Jim, we did get a little feedback about the idea of having guests on. And ZL says, bringing in people to brag about income and buying expensive real estate would turn the show into Dave Ramsey light. So 100% not talk. I don't watch, I don't watch or listen to Dave Ramsey. I catch clips, and the clips that I watch are the ones that interest me. So I'm sure there are buttholes that call in to do that. But what we're talking about is the real people here that watch the show, that reach out, that we close loans with, just to give you an idea of what that looks like. Like, by all means, I've got a client right now buying a $3.4 million home. I've got a client in Texas, listener to the show. She's buying a $230,000 house.
A short sale.
A short sale. And it's a nice little house. So a very wide spectrum of listeners, of clientele. And really, I think that's valuable to everyone. I mean, we've got a listener to the show. Jeb, you went and showed a $1.2 million house today. And that is an entry-level home in Orange County. So if someone watches that and goes, oh, you're rich and you're so flaunting your wealth, it's just the cost of doing business and getting in to this. And with their income, they are very well qualified. And with their income, they don't feel like, oh, we're rich, we can do this. They're like, how do we get something cheaper? How do we get a lower rate?
Sure.
How do we get, so these aren't people that are going to be flexing on how great their finances are. I mean, this is the real world in 2025.
Yeah, there you go. We have someone here asking Josh if they can refinance. First, I mean, like, I don't even think it's important to talk about their loan balance and their credit card balance. They got a 590 credit score. What would you recommend?
So Fannie Freddie, 620 minimum credit score. There are some exceptions, but it doesn't sound like there's another borrower. So pretty much 620. So FHA will allow you to go 580. You are very unlikely to get an automated approval with a 590 credit score. If you have equity in the home, the more equity you have, the more likely we are to be able to get that done for you. So yeah, it's possible, but it's most likely an FHA loan versus a conventional. If you're VA eligible, same thing, no minimum credit score. So from that perspective, you're going to be limited in terms of your options, but there may be options.
All right. Sam purchased a home in May because it had a 4.99% interest rate over an extremely similar home at a much better price, but a 6.8% interest rate. Should I have gotten the cheaper house and refinanced eventually? To each his own.
Only time will tell.
Yeah. I mean, here's the thing is, like, if you can buy two homes, one is less expensive monthly, but the other is less expensive on the price in a substantial way. I mean, if you're holding it long term, the right answer was to take the lower price home with the idea that you can refinance it over time and take advantage of that. With that said, if you couldn't qualify or you couldn't take the payment right now because of, the position you're in, and the 4.99 is the only way you could do it, and that's the house you wanted, then that's the story. I mean, you got to go with it. You can't beat yourself up over something that happened there. And it could be years before we see a 4.99 or lower interest rate again. So hard to say. I mean, I don't know that there was a right or wrong answer. I think each person chooses that a little bit differently. But what I will say, and I say it all the time, is people live in the payment and not the price. And I have people all the time tell me, no, I would much rather have a lower price house and a higher payment than a lower payment and a higher price. And I go, bullshit, because
builders have proven that is not true.
You just proved that, Sam. That's why people lease cars versus buying them. It's less expensive to do that. So that's what it is. So I don't beat yourself up. Move on. As long as you own the house for a long period of time, it doesn't really matter. You'll be in a good position either way. So good stuff. All right. Bullshit. Let's see here. Shadow Urban.
Shadows Urban.
Recently bought a, what's that?
Plural Shadows.
Shadows Urban. Recently bought a rental in Phoenix, going to stabilize this and want to use an FHA construction type loan for my next property. Would this be the same process of obtaining a normal FHA loan? Can you have two FHA loans at the same time, Josh?
This is a recent question. We didn't say he bought the first one. He said he bought a rental. So it shouldn't have been an FHA loan if it was a rental.
Sure.
If we're going to use, so are we talking about an FHA construction loan or an FHA renovation loan? FHA construction loans are out there, but they are very rare. Only a couple of lenders do them. They are the same as a normal FHA loan, but very unique, limited in who you can get them from, a very different process. So we're talking about an FHA renovation loan, a 203K, where we're buying the home and financing the improvements. Very similar to a normal FHA loan offered by many lenders, slightly higher interest rate, a longer, more involved process. And depending on the amount of repairs you're doing, there could be like this mini 203K that is pretty simple and streamlined, or a full one where you're doing $100,000, $150,000, $200,000 of repairs in the property, and it's more involved in terms of plans, getting an FHA inspector to sign off on the plans and things of that sort.
All right. Question right here from Mr. John. Is it possible today, Josh, to get an interest rate on a VA loan sub 6%?
3 veterans I'm dealing with right now, all of them are below 6%. So use the link below and reach out, and we can go through exactly. So the excellent credit score, it doesn't affect much because you only need about a 680 to fall into the best tier on VA. But if you have excellent credit, you absolutely should be under 6 with 0 points, because that's the other fun one, Jeb. I've 2 of those veterans that I'm talking to said, yeah, I'm getting quoted 5.5, no cost. I said, cool, send me over what you have. And what we get is no upfront costs, meaning all of the costs are rolled into the loan, and charging them a couple points, which they absolutely did not need to pay.
And I think this is a good time to pitch this. So Monday's episode coming out is about the beautiful bill, the big beautiful bill. Sorry, didn't want to forget the first B of that, and its impact on the housing market, affordability, taxes, all that good stuff. So that'll drop on Monday. The following Monday's episode is the one we recorded today, where we talk about how to shop for lenders, whether you're refinancing, whether you're purchasing a home. Go through that process, what that looks like, what you should pay attention to, avoid, and all that good stuff. So if you're not subscribed to the Educated Homebuyer podcast, make sure you check it out and turn on those bell notifications so that you get it. Mr. Lewis, I've got a question here about stock portfolios. Said, would it be a smart idea if somebody has a 6-figure stock portfolio to use part of that for a down payment?
Opportunity cost. So it's making money for you in the stock market. We don't know what it's going to do in the next 6 months, 2 years, 5 years, but over time, if that money sits there, it's going to make a rate of return. If you take it and buy a house, you're going to lose that rate of return, but you're going to realize appreciation. If it's a house to live in, you're going to fix your homeownership costs, put a roof over your head. So you got substitution there. So it really is a personal question. No one can tell you, hey, you should do this. If you don't have any liquid cash that's saved for buying a home, absolutely. And really, it becomes down to a balance. It sounds like you're leaning towards, hey, I want to keep my money invested and growing and working for me. And if that's the case, then let's look at how little of that money we can pull from there to still get you into a home that you would be happy with.
All right. We had Josh. I mean, we talked about this before. Maybe I don't even know if it was on air or off air, but how often are you seeing people do short arms, 1-year arms? I don't even know. Do they do 6 months now?
Very, very rarely. The guy that's buying a $4 million home that I'm dealing with right now, he has a $12 million portfolio. He's going to do a 6-month arm because he's watching the Fed and he says, I think we're going to get 2, 3, 4 cuts over the next year. That arm is tied to the SOFR index. SOFR is very highly correlated to Fed funds, to the prime rate. So when we look at that, if we're all right, the Fed's going to be cutting over the next year, he's going to ride that lower. So he's starting at a much lower interest rate and going to ride it even lower. For most people, that is very, very inappropriate. He can take on that risk because it doesn't matter. I mean, it's going to big monthly savings. And if it goes the other way and it ends up costing him a bunch more, he can absorb that. For most of my clients, not appropriate at all. And many, many people, when rates first started going up in 2022, were sold into that exact program with the promise that marry the house, date the rate, in 6 months, 12 months, we're going to refinance. And instead, those people, when the Fed was on an aggressive hiking cycle, ran that all the way up. So it's a very, very inappropriate product for most people. It can be a great tool in the right situation for those that understand it.
All right. A follow-up question or another question about stock portfolios, just asking a similar question, Josh. Just saying, can you borrow against a stock portfolio for a down payment?
In general, yes. We have to count the payment against you. We have to get the terms of the loan, what would trigger it. So in general, yes, not all programs. So definitely your mileage will vary. So if you have stock funds that you're wanting to borrow against for a loan, let's have a conversation before you just assume that the answer is yes.
All right. Steve is coming back in with another question about buying a second rental property by the end of the year. He's got a very low DTI, planning on doing conventional for a better rate, but asking about a DSCR loan for this one. The goal is to buy rental number 3 in 2 years. So maybe explain what a DSCR loan is, Josh, and so our audience understands it.
DSCR stands for debt service coverage ratio. And it used to be that if the rents were 125% of the payments, then they would use that to qualify. And then they got more aggressive and it was 100%. Then it went to 75%. So some of them, the rents can cover some portion of it and it doesn't matter. The less it covers, the more you may need to have some of your own income to offset that. But at 100, 125, they look at it and say, this property is self-sustaining. It will pay for itself. So it can be very helpful for people who don't have traditional income or who are business owners and don't show a lot of income and they're buying a rental property. So what I always say is you don't do that until you need to do that. So if this is number 2 and you can still get the conventional financing, then do conventional financing. If and when you buy number 3, if you now don't qualify, now look at the DSCR. Don't pay a premium. You'll always pay a higher rate of interest for that DSCR loan. With excellent credit and huge down payments, it's a small premium, but there's always at least some premium to conventional rates with that.
All right. While we're waiting on the next question to come in, I'd like to take a minute and ask a favor. If you find any value tonight, we answered your question. You listened to somebody else's question, you found value, do us a favor, hit that thumbs up. If you haven't subscribed, consider doing that. And I think what I would like to ask is that you share the channel, the show with somebody that, you know, is looking to buy a home. I think that's really where we benefit the most is getting out there in front of people that are considering going through the process and need the education. Because, you know, we find people all the time, hey, we didn't know the show was out there.
Wish we had found this before we bought.
We're already in escrow. We had no idea. And I'm like, how did you have no idea? But here we are. All right. Okay. So Willing is asking, does metal frame always mean barndominium? Or is it possible to still be considered traditional home, single family? Barndo programs are much different than traditional. So Josh, I don't know anything about barndominium financing. In fact, I've never seen anything. I mean, where we are, we don't see anything mentioned with a metal frame. So I'm sure in Texas and some of these areas with a lot of land, that's mentioned. Any thoughts on this?
They are more common everywhere, but you're right. Texas is sort of the heartland for these. But Willing says Barndo programs are much different than traditional. They absolutely do not have to be. Most barndominiums, if they are built to local building codes and there are comps that we can use this type of property, you're not going to have a problem. So I would run it by the appraiser first, reach out, have them take a look at it. But there's nothing unique about most of them the way they are built. It's post-frame construction. It ends up you have bigger spans, but most of them are still built to the same building codes. And I've done one conventional. I was going to say we have a friend, but then I remember you don't know this person, but retired cop. He bought some land up in San Luis Obispo, Jeb, and he tells me, yeah, I built a house. And then once it was built, he's like, yeah, I want to refinance it with you. I get the appraisal back. I'm like, bro, this is a barndominium. He goes, yeah, it's a barndominium. We had zero problems doing a conventional refinance. FHA and VA have indicated they're okay with it. I haven't closed either of them, but a lot of it comes down to the specific property and just making sure there's nothing weird or unique about it. But most of them can go with traditional financing.
All right, there you go. I'm learning along with you guys, which is perfect. So at the moment, been on 51 or so minutes. Looks like we've run through all of our questions here at the moment. Now, if you have a question, it's a good time to get one answered.
Yeah. We need to ask our question again because Kendra came back in and said number 1. I don't know if number 1 or number 2. Which one was yes guests?
1 was yes.
Okay, so 1 was yes. I think we only got
2 was
3
pound
answers.
sand.
We got 1.
Pound sand. Quit YouTubing.
So Heather also said 1. Ryan said no 2s, LOL. Didn't just so against it. He's telling the rest of you to not answer with a number 2. So if you want to hear the question again, would you like to hear episodes of the podcast where we have a breakdown of someone who has successfully closed on their home and what the process looked like, what they wish they knew, what they wish they had done differently, what they were happy with, and what worked well? So 1 is yes, and 2 is no.
There you go. And it will be, I don't even know that it will be a video on YouTube as much as it will be a conversation, because depending on whether these people want to be on air or not, right? Will it be a conversation on the actual podcast? So somebody earlier mentioned Ramsey-esque, Dave Ramsey. It's honestly, it kind of stems from that to some degree, because those conversations, if you get the right ones, are good conversations. You can learn a lot from somebody's conversation, and just why they did certain things, and hear 2 professionals kind of, talk about it. And it comes back and says everyone's situation is different. It is, but that's the point, right? I mean, the question always is who's buying, we can give you a lot of people who are buying. ZL, you just don't have to watch those.
ZL has voted for the second time. He's very adamant that we not have any guests on.
Yeah. In fact, if you got the bell notification on, you should just turn it off so you don't get those. How's that? You just get the lives.
Maybe they need a bell filter that when it's a
bell
guest
filter.
episode,
Yeah.
then I don't have to hear
no
that.
twos. No twos. Don't send me the twos. All right.
No one's popping up with questions. Willing says he's using his derma roller on his head again tonight because his crown is dwindling. Also would like to know if rage can carry you to greatness. So if you could tell him that, that would be nice, Jeb.
You know, I don't know. I don't, there was a time where rage, when I was in the mortgage business, I had rage because I felt like everybody I dealt with was an idiot, and I had rage daily, and it didn't carry me. Actually, maybe it did carry me to greatness because I got smart and got out of that.
Jeb, you may or may not remember this, but about 15 years ago, we took a road trip. We rented a Sprinter van, about 8 or 10 of us. Went up north to a seminar, came back home. Jeb was still in the mortgage business at that time. He was transitioning. It was one of the last loans, and he was just F-bombing this person on the phone all 400 miles home from Northern California. So that may have been the impetus.
That was the greatness.
To no longer do loans.
I think that was that's what set me up for greatness because I quit. I was done at that point. Yeah,
pushed you right out the door.
That was it. Anyhow, yes.
So rage can carry you to greatness. That is the answer.
Yes, it absolutely can.
Cow Vu would like to know, should we be looking to refi? The answer is it depends, but many should. We have the refi watch list. We've got about 180 of you guys on there. And I would say, because we have the data, probably 40 or 50 are in the money right now. Another 40 or 50 are very close. So we're going to start outreach in the morning and going through and updating and revising the numbers, because a lot of people should. So if you want to get on that list, or if you want to just use the scroll there, so there's the rate watch. It'll give us the info for us to be able to run the numbers, set you up on the rate watch. If you just want to schedule a consultation so we can go through the numbers and see if it makes sense. And if it doesn't make sense today, we set a strike rate and say, this is where it needs to be for you to make sense. So jebsmith.net/start, use that. It'll get you connected to us and we'll go from there.
Or you can just go to /rate watch and that'll get you there as well. Platinum ask, when's the One Beautiful bill coming out? It will drop on Monday, 5 a.m. So our cadence here on the channel, or on the Educated Homebuyer podcast rather, is every Monday. It drops at 5 a.m. Pacific Standard Time. So, and then the lives obviously show up on my channel and the Educated Homebuyer, and then my video usually comes on Sunday at this point. So.
And that was a reminder that I believe I dropped the ball, because I told him I was going to send him a Google Drive link so he could watch the raw video, because he's been wanting that for a while.
Then we actually have it unlisted on YouTube. I don't know if it's unlisted or unscheduled. I'll either way. Yeah. So we can figure it out. Send it over.
Okay.
Hi, Jeff and partner. All right. Jeb and partner. Yeah. Jeb and partner. We are planning to close next Friday, the 15th. Would the mortgage rate go down more? I just joined the chat. Thank you, guys. So, the planning to close next Friday, Josh. Well, I guess they gave it the 15th. So is that, would you be locking right now, or would you be waiting?
Well, here, this is everything since last Friday. You had that big dip on Friday, worked through a little more on Monday, and then we've been flat to slightly increasing. That yellow line, all that is the 200-day moving average. We're slightly above that moving average there. So from that perspective, in a short timeline like that, I would be leaning more towards locking. Could rates go down more? Yeah, we don't get a lot of data the rest of the week. Thursday and Friday, not a lot of data. I don't know what we get next week. Are we back around to CPI yet, or is that the following week? Anyway,
you get CPI next week, the 12th, I think.
Okay, that could be an impetus to move them higher or lower. So the issue, the kind of the question behind the question you may not be aware of, Friday the 15th, if we were to renegotiate, so if the rate is locked right now and you want to renegotiate the rate lower, it has to have moved enough, which for most people, if you locked even last Thursday, it hasn't moved quite enough to trigger a renegotiation. But even if you had that, you have some waiting periods with your closing disclosure that needs to go out before you can sign your docs. So it can cause delays.
All right. Were you done there? Right.
I was done. I was done.
I didn't know if you just got,
I was happy with
internet.
myself because Platinum Black followed up and said, no, that was a different video you already had posted. And I watched. So I didn't owe him that video. I thought somehow I had dropped the ball.
Well, he could have gotten it. He could have gotten early access. Steve came back. My buyer's agent targets more higher end properties. Should I consider switching to an investor oriented buyer's agent that will write lots of offers to meet my needs? Tricky question, right? So, I mean, unfortunately, Steve, I'm a bad person for this because I would not be that guy, right? I'm not in the business of writing a ton of offers for somebody to try to get a deal done. I'm in the business of writing offers for people who are truly interested in a property and, that sort of thing. So I don't like the idea of writing a ton of offers and seeing what sticks type of mentality. I see them done all the time. I get them on my listings. It's a pain in the ass. So to each his own. If you can find somebody that can do it, that actually, here's what I'll tell you. Most of the agents that are willing to do that are awful at their job. How's that? The agents that are willing to push back on that are the people that you probably want, but they're probably the people that don't want to do that too. So.
To do it right, to properly package an offer, reach out to the listing agent, have a conversation. What's important to the sellers? Where are you coming from? What's happening? Document it properly. Reach out to the lender. Like if you're just doing it at scale, it's pretty easy for the listing agent to know that you're not super serious. You're just fishing for deals. Jeb, you get offers all the time from these investment groups. They haven't seen a property. You list it 3 minutes later, here comes an offer. How serious is that?
I got an offer on a property that I sold 12 years ago the other day. I forgot to tell you that. 12 years ago.
Did you accept it? Did you tell them where to wire the proceeds?
I'm like, where did you even get the information to even bring this property up? Like, what are you doing? Idiots. Like, I mean, that's the people that are making mass offers out there, and they're actually representing buyers to some degree. Crazy. Let's do this question real quick, Josh. Watching for fun, 28. So if my friend
watches this for fun, especially when they hear our theme song at the beginning.
Well, I mean, the song sells everything, Josh. Inheriting a house, and they are willing to sell it to me for what's left on the mortgage, and I want to do a 203K loan, and they raised the price to cover a closing cost. And then there's a follow-up to it, Josh. Or the property would appraise for more after the 203K. And how does the down payment assistance work for 203K? Blah, 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 blah. So Josh, maybe just talk briefly about it.
There is no such thing as down payment assistance for a 203K. If there is, I'm not aware of it. I just have never heard of such a thing. The 203K is a unique loan. Many lenders don't offer them, but plenty of them do. And there's basically two appraisals done. It's one appraisal with two values, the current value and the after repaired value. The after repaired value dictates how much of the repairs that you can finance. So if you say, hey, they owe, $200,000 closing costs for them and you are going to be $10,000. So they really want 210 so that they're walking away without having to bring money in to close, or you are going to bring in money in to close. Then we got to figure out what's that after repaired value. What are the repairs? Do the repairs justify that value? And then you have a one-time closing where the proceeds to pay off the underlying loan and cover all the closing costs closes, but you're going to be making a down payment. And the down payment is going to be based off of the full loan amount, not just the purchase price, because that's just the way the program works.
There you go. In fact, I don't know if we've done that video on the Educated Homebuyer, but I've done it on my channel breaking down 203Ks. So if you don't understand them, if you go to Jeb Smith YouTube channel, you can search 203Ks and there's a video there. Last thing I want to end with, Josh, is Wesley does not watch this for fun,
got jokes,
but he believes that you have to do hard things to be great, and he sits through this and sacrifices everything that's important to him to be with us because it's hard on him. Therefore, we're grateful for that.
He's been taking singing lessons, and what he's talking about, it's hard for him to learn the theme song and to sing it properly. And that's hard, and he's working on greatness so that he can sing it properly at karaoke night.
There you go. We're going to play it. All right, guys. See you next week. Adios.
Amigos.